Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Jerry O'Flanagan, an EVP at First National Bank of Omaha, overseeing their partner customer segment. We talk a lot about Jerry's experience as a small bank that's actually quite large in credit card and what the challenges are. It's a kind of unique position, but also the kind of unique capabilities around analytics and data that they've developed because of that kind of focus on specifically on credit cards as a large portion of their portfolio. We actually delve into Jerry's thoughts on BNPL as a credit card bank. I thought that was really interesting. Something he didn't, I don't think, appreciated when it was coming in, and they've kind of pivoted and are really investing in that space now. So interesting to see what they're doing. And finally, I really enjoyed the discussion about how Jerry thinks about a business within a business way to incubate innovation within the institution, and how you can try and get your institution moving faster in terms of innovation and maybe unlocking small teams to pursue new ideas without some of the decision-making bureaucracy and overhead of the institution. Great thoughts for anybody in banking who's looking for how do I get a new thing out the door and moving quickly to kind of improve the customer experience and capabilities of the bank. So please enjoy this conversation with Jerry O'Flanagan. Well, Jerry, thanks so much for joining us today on the podcast. I really appreciate your making the time.
I'm delighted to be here, Jeff. Thanks.
I feel like I've been in your offices in Omaha, and now we're doing it virtually. It looks different virtually than it does in person, but it looks like a nice day there.
It is a nice, a little cold, but it's nice. How was it where you were?
It's a nice day and warmer because, in the middle of February, Omaha is a pretty cold place compared to most places.
It can be. Yeah.
I've started beginning all of my podcast sessions with the same question, which is, roughly most of us didn't grow up dreaming of being bankers. And yet here we sit. And so I'd love to kind of understand your path to where you're at today. Like, kind of what brought you into the industry, and how did you end up, being a bank executive?
Well, it's a good question. I think like most people, I didn't know what I wanted at all when I graduated college. I literally was a deer in headlights. My parents were really both educators. I knew I didn't want to teach. So, I had an economics degree, and I ended up getting a job at a company called AIG in New York. And that lasted for a little while, not too long. I really didn't like it. Had an interesting stint right after that at a company called Ebasco, which was an engineering firm for nuclear power plants. And they were in the World Trade Center. And I did that. And then my journey sort of ended, at still a very young age. I was all but 25, beginning at Citibank. And that's, I remember I had a very good friend who worked at Citibank, and through just happenstance, they wanted to talk to me, and I got into consumer lending in the credit card division, beginning as a controller. And it was there really that I really learned consumer credit. Citibank, especially back then, did a lot of pioneering things. I worked with brilliant people, and really that got me started. So that got you on your journey. Citibank credit cards. Yeah,
I like it. It's fascinating too to me because at FNBO you guys have a pretty large credit card program, compared to most banks your size, or frankly, most banks I talk to are typically not running their own credit card program. There's a few of them at scale, and a lot of them that really don't exist. Talk to me a little bit about what it's like. I mean, your business is quite a bit different than most banks in a similar asset category size.
Yeah, I think that's true. In fact, I think we're the only bank our size that has this kind of concentration in credit cards, because it is, for us anyway, rather large. We've been in the credit card space for a very long time. We're a privately held company, and back in the 50s, our one of the owners, got into credit card, and actually was one of the founding members of the Visa organization. And we've always been involved in this. And as you learn when you're in this space, regardless of whether you're $100 billion receivable company or a $10 billion one, you still need the organizational apparatus, the sophistication to execute against marketing programs, credit programs, analytical programs. And so it requires a level of investment that makes it, I think, difficult for smaller banks to get into it. But given that we've been into it for generations now, and we've made the investments and continue to make investments, we know what we're doing. And I often say in groups, I would put our organization, head to head with any of the big organizations. Again, given that the organizational apparatus needs to match up. You need to do this well. There's no doing this halfway.
No, credit cards is a dangerous business to be halfway into. I'm curious how you think about, though, as an organization that's smaller and obviously doesn't have the budget of a Citibank or a Chase or one of the large guys. How do you think about building that capability in-house? Because I will say most of the financial institutions I talk to, banks and credit unions, struggle to build sophisticated analytics, modeling, credit teams, to keep them happy, to build a culture in a workplace where they can do work that they find both meaningful and fit into the overall culture of the org. How do you think about managing that? Because I will say in my interactions, your team is some of the most sophisticated, to your point, of any bank we talk to, let alone just of a smaller size bank on the asset scale. How do you think about building and maintaining a team like that?
Well, certainly our longevity in the space is an asset to us, given that we've been doing it a long time. We're known, and obviously the talent that, I hate to say this, but that matters a lot is the analytical talent, the statisticians, the credit talent. And, for sure, we look all over the place to get the very best. We act as incubators for schools in the Midwest. We have internship programs, and through the years, we've been very successful in attracting very top-notch talent. And I think also we work on really exciting stuff. We're not, I always thought credit card was its own management science to begin with in banking. And it's always been on the forefront when it comes to technology, marketing, and credit. So there's a lot of intellectual curiosity that it attracts. And I think because of that, we end up getting some really good talent.
I was going to say, why do you think that is? It's interesting to me that you say that credit cards kind of on the forefront of new technologies, new approaches, credit marketing. Why do you think that part of the lending space has seen maybe more innovation and investment in the technology, the analytics side than more traditional products like mortgage or auto loans or things that are maybe less sophisticated often in their approach?
Well, I think that because to do it at a mass scale, you need to invest in tools that are credible. You need it. It's funny. I was thinking about this. I don't know who, it predates me, when the first score was developed, probably in the 50s or the 60s. But honestly, you could not run a modern consumer lending franchise without scores. I mean, what's the alternative? Judgmental reviews? And banks used to do that. So I think, when you juxtapose the credit card operation to, let's call it traditional banking, which is heavily judgmental, let's face it, it is less dependent on scores. That's changing somewhat, I would say, especially in the small business space. But large corporate lending is very much a business of de novo. It is not the case when you're talking about mass consumer lending franchises. You've got to be able to adjudicate risk on a mass scale efficiently. And so, that I think breeds a sort of spirit of innovation that, continues to this day. And we see it with the mass amounts of data now becoming available, and now, the machine, AI, which is advancing our industry and upping our game. And I believe, I know it's a circuitous way to answer your question, but that is, I think, at the core of it. We've always had to do things as efficiently as possible because we're not making a lot of money on each loan. It's got to be done.
Yeah.
It's a law of large numbers.
Yeah, I guess that's true. When you think about mortgages or other, the size of the loan gives you a lot of room for cost. Efficiency doesn't come from thin margins on high volume. It comes from, kind of, I won't say thick margins, but you've got more room to play. And so I guess that kind of thinness breeds innovation out of just, they say necessity is the mother of invention.
Yes.
Sort of out of necessity.
Very true.
Talk to me a little bit. I think you guys are playing a little bit in the buy now, pay later, but I think the big question of what becomes of credit cards vis-a-vis buy now, play later. There's obviously in the BNPL space a preponderance right now of kind of non-bank players that are doing really well, the fintechs that are lending and kind of I will say, are at least the face of that industry to many. Where do you think that sits next to the credit card space? Does this disrupt credit cards? Is there an even balance? Like, what do you think BNPL represents in terms of a shift of product mix or not vis-a-vis credit cards as a spending mechanism?
Yeah, I don't necessarily see it as a fundamental threat, existential threat to credit cards. I must say, and I say this with some embarrassment, when I first really became aware of buy now, pay later, I remember, and I won't mention the network, but I was at a senior council meeting and the CEO was talking about the buy now, pay later phenomenon, especially outside of the US. Mm-hmm. And it struck me as odd because these were loans that were typically $100, spread out over 60 days or so. And I didn't think of it as serious. I thought that, why would you pursue that, all the energy and when a credit card can do that and so much more. Yeah. And I must say, I've been humbled, deeply humbled, and because that has taken off and it shows you the power of the experience, the digital experience and the single purpose, discrete purchases, mm-hmm. with that offer from a consumer standpoint an excellent value. So fast forward from 2017 to 2021, I began losing sleep over this. It bothered me so much. So we stood up a buy now, pay later business in 5 months at the bank, and we already have our first set of partners, and we're booking loans, and it's going great. I see this, if we do this correctly, as a conduit for the credit card. These are often customers that we have traditionally not underwritten, and I think could be great credit card customers. They can be graduated in short order to a credit card, and then maybe get a customer for life. But I see this, and this is probably one of the virtuous things of fintechs, that I think they're bringing so much creativity and energy into the consumer financial space. It's, as an older banker, I missed it. I admit it. I totally missed it. I just didn't take. I remember telling my boss, I think this is my number one fail. How did I miss this? But I do think that the two can work in tandem with each other very well. It doesn't have to be a zero-sum game. I think this is actually a good thing for consumers and financial institutions.
I'm curious if you see anything in particular that drives, I've been curious what it is about the BNPL that has made it, I'll be honest, I had the same reaction. I'm like, why would I do that? I've got like a thing right here. I'm pre-approved. There's already a distribution mechanism. I just swipe it. All the merchants accept it. I don't have to find things. But as I've thought about it, I kind of see three things that are really different, or at least two. One is the integrated experience, but one is the shift to an installment, and maybe you can split installment and single purpose loan, where I think for many, there's a concern about revolving credit, not understanding the cost of revolving credit if I'm really borrowing over more than a couple of weeks. And the second was obviously the ability to embed merchant incentives into the credit offer in a way that typically credit cards hadn't done, right? There was a swipe fee and there was obviously economics coming from the merchant, but in many cases now there's 0% interest for 12 months, which in a traditional credit card world would put you upside down on the transaction. And yet merchants are willing to be more generous where they can see increases in ticket size or conversion rates, and they're putting a little more money in play. So the BNPL kind of brought some merchant incentives into the program that lowered the cost for consumers. I like if free money is good, zero interest is good. I like that. And then there was this kind of installment versus revolving. I'm curious if those are the things you see, or what you see as kind of interesting deltas, really practically speaking, that make BNPL a better alternative in certain use cases, or reason consumers might be picking it over, the more traditional credit card that many of them already have in their wallet?
Well, one, I think it's an alternative lending facility that is discreet and offers the consumer another venue to manage their finances. Number one. I think number two, and I think even more important, the experience is fantastic. I mean, having built this ourselves now, it really is a cool, slick, seamless experience. I also think, and you hit on this, Jeff, I mean, it's a great deal. It's an absolutely great deal now we offer 0%. I mean, all credit card companies do, on balance transfers for transactions and rollovers. But I guess it's the nature of the experience that is so compelling. I would end by saying that this isn't, in some respects, at all a new idea. I can remember even in my early days at Citibank, looking to do the same thing on the back end. If a transaction was over a certain dollar amount, the consumer would have the opportunity to put it in installments. You see it with Amex today, with Planet Pay It. It's the same concept. And other banks, and I know the networks are trying to build that capability. And I think that is taking off. But that capability has been around, that idea has been around. It never really took off. I think it's the point of sale experience that is so compelling that is driving a lot of consumers, especially younger ones, to it. That's my opinion.
Yeah, I mean, and it's one of these things that I think is really interesting about the fintech space is that I feel like a lot of things, everything old is new again. We're coming back to old ideas, but the automated nature of credit decisioning, the digital nature of interactions. I mean, you used to take a credit app, 20 years ago, if you were in the store, you had to write it out and call somebody. And now you can make those things instantaneous, and those things that maybe didn't work as well, conceptually made sense, but practically didn't execute as well 20 years ago. Today, they can execute really well. And so those old ideas are getting new life because they actually work much better from the actual day-to-day experience of putting them in practice than they could have before.
Yes.
You talked about kind of fintechs. Where do you see the most interesting innovation in fintech, and how do you think about, as a bank, about where fintech sits in the industry vis-a-vis partner? What's the old phrase, frenemies? Are they friends? Are they enemies? Are they inspiration? How do you think about fintechs and where they fit into the space these days?
Well, I mean, I look at them more and more like inspiration. I think that they are, they're frenemies, but I'm amazed at the creativity and the elegance of what they're bringing to market. And now, for sure, they're not saddled with legacy technology that most institutions like mine are. After all, our technology stack is 40 plus years old, and while we're furiously trying to modernize that, it'll never catch up in any meaningful way to a startup that has no baggage. And so for a bank like ours, to really effectively compete, we have to be willing to disrupt ourselves. We have to take inspiration from the fintechs and really build a business within a business, and decouple from the existing technology stack and create a new technology stack. And you have to be willing culturally to do that. It's not easy to do, but we are pursuing credit card as a service, and we will be standing up later this year our own national direct-to-consumer digital bank. All of this has been achieved through a recognition that we couldn't do it in the existing technology stack and the cultural and decision right limitations that are implied by that we needed to break off and think of a new way. So I'll end where I started. That's why I look at the fintechs as inspiration. I think that they're a virtuous adjutant. That's a phrase I like to use. They're teaching old dogs new tricks, and And I wouldn't rule the big banks out. They still have enormous capital and enormous resources that they can bring to bear. But I think culturally, all institutions like mine have to be willing to go out on a limb and do something really unique and different within the institution.
I like virtuous adjutant. I'm gonna take that and make a sticker for my laptop that says that or something. I like that one, Jerry. But I want to ask you how you do that, because I mean, if you read Clay Christensen, as I think everybody in Silicon Valley has read, you got the kind of disruptive innovation, and the advice is kind of like, what do? Well, you stand up a business unit that is not subject to the technology stack and or decision-making processes, or the question of like, well, that's a lower margin business. Why would I want to attract a customer to a lower margin version? I've got the higher margin version here. Like, that's a bad thing. But it really requires quite a bit of a separate culture and insulation from decisions or business problems that the new business within a business might cause for the older, bigger business. How do you actually set up the ability for that team to execute differently, to operate differently culturally, to be a little removed from the politics of other business units that might be disrupted, or the decision-making processes? Because it's an easy idea to state, oh yeah, you just stand up as a separate group and give them freedom and they'll go do the thing. And it's a very different thing to actually execute. And I'm curious how you thought about making that a reality, because it feels to me very hard to do, particularly in the context of a more traditional cultural institution like a bank.
Yeah, no, and you hit the nail on the head. It's one thing to say it, it's very hard to do. This business is all about the execution. And
Yeah.
I will tell you, it's not all 100% figured out. What you just articulated is very true. The cultural differences are real. The decision right authorities that we allow, we're still rubbing up against. But you have to be committed to deploying new management techniques. In our case, we're deploying agile marketing. We're taking people from different businesses. We're putting them together. We're giving them a single purpose to solve. We're even creating new workspaces that are very modern and very flexible. We're taking them off, spaces where they traditionally worked, and we're allowing them to run. And I think ultimately, one area, one recipe for success, I believe, is you've got to have executive endorsement. You've got to, the executives have to be behind this 100%. So, I run what we call the partnership business, which is credit card and loans, and I have all the operations, customer service, collections, and all that. I'm behind this 100%, and my boss, who runs the company, is behind it 100%. And we talk about it in our board meetings. I mean, and so everybody knows that this is mission critical. Now, having said that, we're still, we still have our areas of struggle. This stuff is different and it's hard.
Yeah.
But it can be done. And in our case, I think an example of success has been the buy now, pay later launch, which I mentioned earlier was done in record time. That could not have been done in the old way of working.
Interesting. What were the specific things that you think freed that team up to, like someone else was trying to, well, not say BNPL and kind of competing against you guys, but was trying to launch a new product like that? What are the specific decisions or kind of things you freed that team from that you think were most critical for their being able to execute quickly, successfully?
Well, getting a business manager in place who's exceptional, having a small, crack, agile team, moving off premises, going outside the technology stack, our current one, and engaging outside software builders to build out platforms for us. Thinking about, creating a sense of urgency. And there was one that we had to do this. I mean, I have a cacophony of partners across the United States that were asking for this. I want to keep those partners with us. It was important that we have this product, that I think will work in harmony with a credit card. So all those things mattered, I'm very proud of the team. And again, in 5 months, that's unheard of from start to finish. And we achieved that with a maniacal focus and a mission critical attitude.
Yeah, I think one of the things I've learned from being early at Upstart and kind of watching through the iteration of taking something from idea to execution is like maniacal focus on achieving a specific objective is really powerful. And often in a large institution, it's hard. You lose focus. There's all sorts of stakeholders have an opinion, and scope creeps, and it gets harder. And when you can really focus on, this is the thing we're going to do, and we're going to get it done with a small dedicated team, it's amazing what that team can really achieve in
It
relatively
really
short
is, isn't
time.
it? You free people up, you kind of unshackle them. You know, it's amazing what a small group of smart, dedicated people can do.
There's some quote about that for never doubt that a small group of dedicated people can change the world.
Yes.
So I think it's West Wing is where I found that's one of my favorite old shows. I was going to ask you, so your other, thing you talked about here was your kind of national digital bank that you're standing up. Talk to me a little bit about the strategy behind having that, because you guys are pretty strong regional footprint, in your local geographies. What's the thinking behind a national digital approach? I know that's not live yet, I think you said, but it's something you guys are working on.
Well, again, I think it's in keeping with our commitment to innovate, and the idea of being digital first. When this was conceived, deposits weren't as cheap as they are now. So one might say it might not be most important, but it is important. Really, at the end of the day, the deposit franchise, it arguably is our most important asset. And our ability to get deposits and customers and leverage customers in a new and different way. For us, a traditional bank that largely has been, brick and mortar branches, this was another opportunity to just break from the machine, and start with a clean slate. And like buy now, pay later, like credit card as a service, we have a small dedicated team. We've empowered that team, and we're going head first into the direct to consumer space. So it's going to be very exciting.
Yeah, I'm excited to see that launch and see what you guys do. Let me flip that one around on you a little bit, which is, how do you think about, there's just kind of another challenge to this approach, which is like, you still have your traditional customer base who are used to the brick and mortar and probably want some digital capabilities and transformation. And, like, transformation is maybe the cliche word, but bringing those digital capabilities into your core banking customer set with that are operating on your old technology stack. How do you think about the balance between, standing up a business within a business that can kind of be new, but if you've got somebody who's been banking with you for 20 years, it has a mortgage and a car loan and a credit card, like, they're not shifting to the new system. They're all in the old system. So how do you bring some of that innovation back into that kind of core fundamental business? Because you don't want to, I would imagine, just leave those guys behind on the old stuff and go, wow, that stuff's too bad for you guys. We're going to go build the new stuff for the new people.
Yeah, that's a great question. And we grapple with that. I mean, that like I said earlier, we continue to invest in the core. So our digital capabilities are still quite good, and they're getting better. What I'm talking about, this new business, is a complete departure. It'll even be branded differently from our bank name today. And yeah, we will have some of those conflicts for sure. And I don't have all the answers yet, but I believe it's through doing, you learn, and hopefully over time there will be knowledge and technology transfer back to the core as we learn our way. But I think for a bank like us to get into a national space like this and do deposit gathering, we could not use our existing infrastructure to do it. We'd set ourselves up to fail. It had to be done in a completely innovative, unique, new way. And that's what we're doing.
Yeah, I love this idea that the new business units feed back information inside. I mean, they can iterate, learn, execute more quickly probably than the current org. And so they're a faster place to learn, but ultimately some of that learning probably comes back and evens out over time. But it's great to see that kind of execution, because I think it's really hard to do. I mean, I kudos to you for pursuing that path, because I don't think it's the natural path for, most financial institutions to kind of unchain that kind of innovation and say, well, yeah, you're going to end up with certain experiences that are better for the DTC, the national brand, than they are for the current brand. And you go, that's okay. Like, we're not going to stand in the way of that progress. And that's I think a difficult cultural step for many people to take.
Yeah. Yeah.
Well, Jerry, I feel like we've covered a lot here, from credit cards to BNPL to national brands and business within a business. Were there other areas you wanted to delve into, or questions, topics you wanted to discuss while we're here?
I just think that I know we've covered a lot. Like I said earlier, I'm a credit guy, and I
Yeah.
started out in credit, and I think probably we shouldn't end this conversation without talking about the amazing innovation going on in credit management, which we're seeing as companies are able to utilize more data that is active, that is alternative, and it through that and through more powerful machines and artificial intelligence, we're really advancing credit to more and more people, and that's a great thing to see. And as we get more adept using data, we're also learning some really, I mean, to me, revolutionary things. I'm amazed how important know your customer is. I mean, I always knew it was important, but the idea that there are tools now available that do just an outstanding job authenticating consumers, that they are who they say they are, and that how many banks misidentify bad debt when it's really fraud. And again, this is all happening because we're doing a better job authenticating who the consumer actually is, and it's the result of data and new algorithms and the machines. So I think that is an area, probably could be a whole area for an hour discussion. But as an old credit guy, I just marvel at what is being achieved there. Fascinating.
Do you have a perspective on why this is the moment? I mean, I agree. There seems to be this a lot of movement around the ability to use compute methods to kind of move beyond the score. I mean, I think scores were a really interesting innovation. FICO is from the 80s or something. So it's 30, 40 years of stuff, but it feels like they haven't progressed substantially in terms of at least their practical impact on like how many people can we get through the door for credit. There, have been relatively steady state. And it feels like there's a lot of movement to improve that now. Do you have a sense of why that is? Is there a reason this seems to be a movement for a lot of innovation in the space of credit and the application of some of these technologies?
Yeah, I think we're just in a moment. You have this convergence of more and more computing power that is cheap, coupled with access to data that we've never had before. And there's always, everybody wants to approve as many as possible. And, in every credit model, even today, I mean, it always used to bug me back when I got into this a long time ago, the false positives in every, cohort that you see. I mean, you may have a great approval rate. A 70% approval rate is really great. That means you're declining 30%. And I'll tell you right now, in the 70% that you approve, there are bad guys that are going to go. And the 30% you decline, there are good guys that you didn't.
Yep.
And what's happening is our specificity, our ability to discern the goods and the bads are getting better and better and better. And again, I think it's the result of advancement in technology and access to more and more data.
Yeah, and I love your point about access, because it's the thing I think is easy to get lost when you talk about accuracy, is that an accurate model approves more people. I mean, the most accurate model approves the maximum number of people, without increasing losses. And I just think there's so much room for us to be able to extend credit on better terms to more people with more accurate models. It's easy to think of accuracy as like a thing that's good for the bank, but it's really good for the consumer as well as being good for the bank. Because to your point, like in the false positives, the false negatives that kill me, depending on how you want to define negative or positive, but like in a pool that's too risky for a bank to lend to, you go, well, that's 20% defaults. We could never go there. And I go, that's 80% goods. Like you're declining 8 out of 10 good people because you couldn't find a 2 out of 10 bad. That seems like a bad thing for the 8 out of 10 people.
It does.
And that's the thing that I think it's easy to miss about why this is so important to people.
It is very important to people, and all of them make mistakes. I still remember this when I started working at AIG, in the 80s. I had a checking account at a bank. I won't name the bank. And after 6 months or so, I applied for a credit card and they declined me. They declined. And I applied around the same time to Citibank, and Citibank, who I had no relationship with, approved me. And, I never forgot that decline, because it was so insulting. And that's the thing you got to recognize as you're making these decisions. You're affecting people, and so if you can get more granular and make better decisions and expand the pool, you're in a great place.
Yeah. And to your point on false positives are bad for the consumer too, because when you give somebody a loan they can't pay back, that is not helpful to them. So the more Absolutely. You can be accurate and keep and limit both of those, the better off you are. But maybe that's a great way to end the discussion and move on to my final three questions. It's like, I love the focus on keeping the real impact of these things. It's so easy to get caught up in the numbers. It's an Excel file, and it's really people's lives. It's people's access to credit. It's individuals, and they respond to these approves and declines, and it changes their opportunities and their ability to access those. And it's, I think, maybe so central to banking to be able to remember the people at the end of the day and not just the numbers on the spreadsheet.
Yeah, I agree. You always got to remember that there are heartbeats behind the numbers. Yeah.
Yeah, the heartbeats behind the numbers is a good way to put it. Well, Jerry, I always use the same three questions at the end of the podcast to kind of wrap things up. So let me ask them to you here. Number one, what's the best piece of career advice you've gotten? You've been in a couple of different industries to find your way to banking, but what's the best piece of career advice you got along the way?
Don't be afraid to take risks. That doesn't mean be reckless, but don't be afraid to get uncomfortable and to move out of your comfort zone. I think that's the best advice I've ever been given, and I've been lucky enough to dispense that advice to others in my career.
Get outside your comfort zone. That's where all the learning happens, right? Is when you're a little bit outside your comfort zone.
Yes.
I tell my kids that when we go skiing.
Yeah.
All right. So my second question, what's the best advice you've gotten about the consumer banking or lending space? And I guess this is a pretty interesting one for you with the background in credit risk. What's maybe I'll focus on that specifically. What's the best piece of advice you've gotten in that kind of credit risk area?
I don't know if it's advice as much as it's an observation, but just be humble. Be very humble. I mentioned my experience with buy now, pay later earlier, how I was really taken off guard. I'm really trying now to be much more open-minded, and I'm fascinated by what's going on. And then I think, it's just things are changing so fast. Expect the unexpected. I think John Galbraith, that famous economist, said there are two types of economists: those that don't know and those that don't know they don't know. And that's kind of how you can apply that to, I think, to our industry in general. I mean, things are certainly moving fast. I think we all have a point of view, but none of us can be entirely certain. So it goes back to being humble and open.
Being humble. I like it. There's this weird inverse relationship I find between knowledge and experience and humility in some ways. Like one of my teachers once described knowledge as a circle, and she said the bigger your circle, the more you know, the bigger the area you contact the stuff you don't know. And so sometimes the people I find that are most humble are the ones who know the most, and they go, I know enough to know that there's a lot I don't know, and they're maybe more humble in their approach, which is just really interesting. I like be humble. And I think it's so interesting to find that the people I find that are the most humble are the ones that I feel like have the most right to be arrogant in their level of knowledge and experience. And yet they're the ones who can take a step back and go, oh man, there's so much I don't understand so far.
Those are wise people.
Yes. I try to emulate that, although it's hard for me. And my last question, do you have one bold prediction about the future for us? Banking, lending, world, and you can't do a Super Bowl prediction. This is going to come out after the Super Bowl, so that won't work.
I lost that one anyway. But this is, again, it's keeping in mind of what I just said. I mean, I would say I would look for a consortium over the next 24 months to be developed on from buy now, pay laters. I think that the fintech infrastructure folks will get around to forming a new network. They're going to want a piece of that economic pie. So I wouldn't be surprised if you see something like that emerging over the next year or two.
I think that would be a truly fascinating development, because it's a pretty stable part of the ecosystem, that consortium network in the middle. But Well, that one I'll be able to hold you to, and we'll see if you're right.
Yeah.
Well, Jerry, thanks for taking the time. I appreciate you sharing your thoughts and experiences. This was a great conversation. I'm sure the audience will love it.
Well, thank you very much, Jeff. It was a real pleasure.